Welcome to your deep dive. Today we're tackling ASX options, and looks like you've been doing some homework with all these YouTube videos on this.
Yeah, bunch of different creators trying to explain these things.
It looks like it, yeah. Powerful financial instruments, so.
Absolutely.
And
So
let's break them down.
we'll cut through the jargon, get to
Yeah.
the heart of what makes ASX options tick.
Okay, perfect.
Right.
So the very first thing then, what exactly are E options?
Imagine this. Your neighbor's house is for sale, but you're not quite ready to buy it.
Okay.
An option is kind of like putting a reservation on that house.
Huh.
You pay a small fee up front
Okay.
for the right to buy it at a set price,
Right.
but you don't actually have to buy it.
So you get to have your cake and eat it too. You get to lock in a price without having to fully commit.
Yeah,
I can see why that would be appealing when it comes to the stock market.
exactly. And that's where ASX shares come in. With options, you're basically buying the right to buy or sell 100 shares of a specific company at a price that's already determined ahead of time. We call that the strike price. And you have to do that before a certain date,
Right.
which is known as the expiration date.
Got it.
And this is a really fundamental concept that you see across many of the videos that you've shared, like Skyview Trading, Financial Wisdom, E-Trade. They all talk about this idea.
So you're not just betting on a stock going up or down. You're actually getting a specific tool to express your view
Exactly.
with a different way of doing it. This right, not an obligation thing is really interesting and opens up some different strategies.
Absolutely. And speaking of strategies, that leads us very nicely into the two main flavors of options,
Okay.
calls and puts.
Calls and puts. This is where I always get confused. Help me out.
A call option is basically like a bet that a stock price is going to go up.
Okay.
And the Learn with ASX video uses a great analogy.
Okay.
They say calling someone up, putting the phone to your ear, wanting the market to go UP.
Mm-hmm.
So if you think a stock price is going to rise, buying a call option will give you the right to buy those shares at the strike price, even if the market price goes way above it.
So it's almost like you're getting a discount if your prediction is right.
Exactly.
What about put options?
Put options are the opposite. They imagine putting your coffee cup down, wanting the market to go down.
Mm-hmm.
So they give you the right to sell shares at the strike price, even if the market price falls below it.
Got it.
So it's almost like buying insurance for your portfolio.
So if I'm worried about a stock dropping, the put option could help me limit any potential losses.
Exactly.
So both calls and puts could be useful depending on your outlook on the market. But before we get into strategies and all of that, I think it's important to talk specifically about the ASX
Good point.
because it's got its own set of rules when it comes to options.
It does. And the Learn with ASX video points out a few things. For example, you can't just trade options on any company. You can only trade options on a select list.
Okay.
It's a list of 87 different ASX-listed shares,
Oh, wow.
plus the S&P SX 200 ETF, which is ASX, STW,
Right.
and then the index itself, ASX.
So I can't just pick any random company and
You can't just pick any random company.
got it.
And another interesting thing about the ASX is the trading hours for index options are different. They start earlier because of the futures market.
Interesting. So a few little quirks of the ASX to keep in mind. Now, one thing that I've seen a lot in these videos is that options can really magnify your gains, but also your losses. Tell me a bit more about that.
Yeah, you've picked out a lot of videos that talk about this idea of leverage when it comes to options.
Yeah.
And it really is like a force multiplier, but on both ends.
Okay.
So a small change in the underlying stock price
Right.
can lead to a much bigger change
Yeah.
in the value of the option.
Okay. So a small change in the stock price can mean a big change in the option price.
Exactly. And Clear Value Tax had a really good example with Yelp.
Uh-huh.
The stock went up 28%,
Okay.
and that translated to a 10x return for the people who held call options.
Wow.
Yeah, that's the kind of asymmetry that really draws people in. But you've got to respect the flip side as well. If the stock had gone down, those same people would have lost a lot more than if they had just owned the shares.
Yeah. High reward, but also high risk.
High reward, high risk.
Exactly. Speaking of risk, that brings us to options pricing, which I gotta say seems very complex.
Yeah.
There are a lot of videos out there that talk about a bunch of different factors that go into how much an option actually costs.
It's true. But you can break it down into three key things.
Okay.
We can call them the three musketeers of options pricing:
Okay. I'm intrigued.
time decay, intrinsic value, and implied volatility.
Time decay. That sounds a little ominous.
Demoniaco ASX describes it like a melting ice cube.
Okay.
And options value erodes as its expiration date approaches.
Mm-hmm.
And the closer you get to that expiry, the faster that decay accelerates.
So time really is money when it comes to
It
options.
really is.
Yeah.
You can't just set and forget this.
Yeah.
You need to really pay attention.
Interesting. What about this intrinsic value thing?
Intrinsic value is basically how much the option is in the money.
Okay.
And that's just the difference between the current stock price and the strike price.
Okay.
The more intrinsic value an option has,
Yeah.
the more will cost.
Okay.
Clear Value Tax and Skyview Trading both do a good job of explaining that concept.
So if I buy a call option and the stock price is already way above the strike price, that option is going to be more expensive because it's got more intrinsic value.
Exactly. And then the third musketeer,
Okay.
implied volatility,
Okay.
which Skyview Trading compares to life insurance premiums.
Okay.
So just like riskier people pay more for life insurance options, on volatile stocks also come with higher premiums.
Uh-huh.
So if the market expects a stock's price to swing wildly,
Right.
that uncertainty is built into the price of the option.
I see.
More volatility equals higher premiums.
Got it.
And Clear Value Tax is very clear on that point.
Right. Okay. So we've got our three pricing musketeers: time decay, intrinsic value, and implied volatility, all working together to determine that option premium. Now, a lot of these videos seem to be geared towards people looking for these big 10x returns. What about those of us with smaller accounts? Are there any strategies that can help us dip our toes in the water without taking on too much risk?
Absolutely. You've got a great source from SMB Capital that goes through some excellent strategies specifically designed for smaller accounts.
Perfect.
And one that jumps out is the Iron Condor.
Iron Condor sounds pretty intense. What's that one all about?
It involves selling both call and put options
Okay.
at different strike prices.
Uh-huh.
And by doing that, you're essentially creating a limited profit and loss range. It's like drawing a box
Okay.
around a certain band of stock prices.
So you're betting that the stock price is going to stay within that box.
That's right.
In
It's a way to profit from stability rather than trying to make these huge price swings.
Right.
And the best thing about it is that it can be profitable with limited capital, which makes it really suitable for people with smaller accounts.
That sounds intriguing, but I'm guessing it takes quite a bit of market analysis to pick the right strike prices for that.
It does.
Yeah.
Careful selection and analysis are crucial.
All right. What are some other strategies for the smaller accounts?
Another one that SMB Capital highlights
Yeah.
is the debit spread.
Okay.
And this strategy involves buying and selling options of the same type. So either calls or puts,
Okay.
but with different strike prices.
So you're basically creating a spread between the two options.
Precisely.
Got it.
And this allows you to create either a bullish or bearish position,
Okay.
depending on your view of the market, but with reduced cost and risk compared to just buying a single option.
So it's like a more controlled way to play the market.
Exactly. You're still participating in those potential stock moves, but you've got a buffer.
Okay. I
Yeah.
like the sound of that. What else?
There's one more strategy that's particularly relevant for smaller accounts, and that is LAP options.
Is LAP option.
LAP stands for long-dated equity anticipation. Okay. And this one involves buying options with longer expiration dates. So we're talking about a year or more out.
Wow. Okay. So instead of trying to time the market in the short term, you're taking a longer term view.
That's right.
Got it.
And it's a really cost-effective way to leverage your view
Mhm.
on whether the stock's going to go up or down.
Okay.
And SMB Capital points out that deep in the money LAPs,
Right.
which means that the strike price is significantly below the current stock price for calls or above for puts,
Uh-huh.
can actually outperform just outright buying the shares
Wow.
in some cases.
Interesting. So you can almost get more bang for your buck by using these LAP options.
It really depends
Yeah.
on aligning the strategy with your market outlook and your own personal risk tolerance.
Great. So we've covered iron condors, debit spreads, LAP options, all great strategies for smaller accounts. But before we move on, let's talk about a strategy that came up that involved actually generating income using options. Covered calls.
Ah, yes, the income generating strategy.
Yeah.
This one comes up in a lot of your videos. Invest with Henry Clear Value Tax, fail, flop, fly.
Uh-huh.
So covered calls involve selling call options on shares that you already own.
So you're using your existing stock holdings to create this income.
Exactly. By selling those call options, you're collecting premium income from the buyer.
Okay.
And they're the one essentially betting that the stock price is going to go up.
Right.
But there's a trade-off here.
Yeah.
If the price goes way up,
Yeah.
you might have to sell those shares at a lower price.
Right.
that you could have gotten in the open market.
Yeah, so you're capping your potential profits, but you're also getting paid to take that risk.
Exactly. It's all about finding a balance.
Okay, so pros and cons to consider. What about these naked calls I've seen mentioned? They seem a bit riskier.
Naked calls are definitely a strategy to approach with extreme caution.
Okay.
Fail flop fly in particular highlights the risks.
Yeah.
It involves selling call options without actually owning the underlying shares.
So you're kind of betting that the stock price won't go up?
That's the gamble.
Yeah.
The reward is that you keep the premium if the stock stays below that strike price.
Right.
But the risk is unlimited.
Yeah.
If the price surges upward, you could be on the hook for a lot of money.
Yikes. That sounds pretty intense.
It can be.
Okay.
Naked calls require significant capital and a very careful approach to risk management.
Yeah.
They're definitely not for the faint of heart.
Duly noted. So we've covered a lot of ground here, from basic definitions to some really intriguing but also potentially risky strategies. We've touched on some of the ASX-specific quirks as well. Where do we go from here?
Before we get into any more advanced option
Mhm.
strategies, I think it's important to understand the Greeks.
The Greeks,
Wow.
like the ancient philosophers.
Not quite those Greeks,
Okay.
but they are Greek letters.
Okay.
And these Greeks represent different measures of risk
Right.
that are associated with options.
Uh-huh.
And understanding these Greeks can really help you to make better trading decisions.
Okay, so each Greek letter represents a different type of risk. Okay, what are we talking about here?
The four most commonly used Greeks are delta,
Okay, theta,
Okay. gamma, and vega.
vega, delta, theta, gamma, vega. It sounds like some kind of secret code.
Hmm.
What do these letters actually tell us?
Well, each Greek tells you something important about how your options value might change in response to different things happening in the market.
Okay.
So we can start with delta. It measures how much an option's price is expected to move
Uh-huh.
for every $1 change
Okay.
in the underlying stock's price.
Okay, so if the delta is 0.5 and the stock goes up by $1, the option price should go up 50 cents.
Exactly.
Got it.
So delta gives you an idea of how sensitive your option is
Right.
to changes in the stock price.
Okay, that makes sense. What about theta?
Well, remember our melting ice cube analogy for time decay?
Yes.
Well, theta is the rate at which an option's value decays
Right.
over time,
Uh-huh.
and it's always a negative number,
Okay.
which means your option's value is constantly eroding
Okay.
as time passes.
So theta is the enemy. We want that to be as small as possible.
Generally, yes,
Huh.
especially if you're buying options.
Okay.
A high theta means that your option is losing value quickly,
Right.
but if you're selling options, you can actually benefit from theta decay.
Interesting.
You're collecting that premium while the buyer's option is eroding.
So theta can work for you or against you, depending on whether you're buying or selling options.
Exactly.
Okay. What about gamma? This one sounds a bit more intimidating.
Gamma is all about how fast delta changes.
Okay.
It measures the rate of change in delta
Uh-huh.
for every $1 move in the underlying stock's price.
So it's like delta's speed. If delta tells me how much the option's going to move, gamma tells me how quickly that sensitivity changes.
That's a great way to think about it.
Okay.
A high gamma means that delta will change very quickly,
Uh-huh.
making your option even more sensitive to price swings
Right.
in the underlying stock.
Okay. So high gamma, more risk, but potentially more reward as well.
Precisely. And then finally, we have vega.
Vega. What does this one tell us?
Vega measures an option sensitivity
Yeah.
to changes in implied volatility.
Okay.
So that uncertainty factor we talked about earlier,
Huh?
a high vega means that your options price will be affected more
Okay.
by shifts in implied volatility.
Okay. So if the market suddenly expects the stock to become more volatile, my option with a high vega will become more valuable.
Exactly.
Okay.
So vega helps you to understand how changes in market sentiment and expectations can impact your options.
Right. So we've got our four main Greeks, delta, theta, gamma, and vega. Each one telling us something slightly different about how our options value might change. I have to admit, though, this is all a little fuzzy for me. How do I actually use this information to make trading decisions? Can you give me an
Yeah.
example?
Of course. So let's say you're looking at an option chain
Uh-huh.
and you're trying to decide which call option to buy.
Okay.
You're bullish on the underlying stock and you think it's going to move up quickly.
Okay.
Now, if you look at the Greeks for those call options,
Mm.
you might notice that some have higher delta and gamma
Uh-huh.
than others.
So those options would be more sensitive to a quick move upward in the price.
Exactly.
Okay.
And if you're confident in your prediction of this rapid price increase,
Right.
you might be willing to pay a higher premium for the option with a higher delta and gamma.
Okay.
because it has the potential to generate larger profits if your prediction is correct.
But a higher delta in gamma also means more risk if the stock doesn't do what I expect.
That's right. A high delta and gamma mean that your option is more sensitive to price swings,
Yeah.
so any losses can be magnified as well.
Right.
It's all about assessing your risk tolerance and aligning your strategy with the Greeks.
So it's not just about picking an option based on the strike price and the expiration date. It's also about understanding the underlying risks and rewards as represented by the Greeks.
Exactly.
My brain is definitely working overtime here. This is a lot to process.
It is. And mastering the Greeks takes time and practice. But by understanding how they work, you can get a much deeper insight into options pricing and risk management.
Challenge accepted. The Greeks might seem a little bit intimidating at first, but clearly they're a key piece of the options puzzle.
They are.
And I'm eager to learn more.
Well, that leads us nicely into part 2 of our deep dive,
Okay.
where we'll explore some of those more advanced option strategies that build on everything we've talked about so far.
Perfect. Looking forward to it.
We'll also look at some practical tips for managing risk and navigating this very fascinating
Yes.
but potentially complex world.
I can't wait. Okay, I'm ready to level up. Part 1 definitely laid the groundwork. Now I'm curious about the actual mechanics. How do you actually buy and sell these options?
Well, imagine you've done your research.
Yeah.
You've picked your stock.
Right.
You've settled on a strategy.
Right.
Let's say you're feeling bullish about Tesla
Okay.
and you want to buy a call option.
Okay, so I'm ready to buy my Tesla call. Where do I go to make that happen?
Your online brokerage account.
Hey.
Most platforms these days let you trade options just as easily as you buy or sell stocks.
So I log into my brokerage account,
Yeah.
find Tesla's option chain,
Uh-huh.
and then what? There's this whole matrix of different strike prices and expiration dates, and it gets a bit overwhelming.
That's true. There are a lot of choices,
Yeah.
but this is where your strategy and your market outlook come into play. Remember those 3 pricing factors we discussed?
Right. Time decay, intrinsic value,
Mm-hmm.
and implied volatility.
Those pricing musketeers. They all play a role
Right.
in determining the premium
Okay.
you'll pay for a particular option.
So if I want to buy a Tesla call option, I need to choose a strike price and expiration date that kind of align with my outlook and my risk tolerance.
Exactly.
Now-
So let's say you think Tesla's going to hit $300 a share within the next 2 months.
Okay.
You could look for a call option with a strike price of, say, $280 and an expiration date 2 months out,
Okay.
something like that.
And then I just place an order like I would for a stock.
Pretty much. You'll
Okay.
see bid and ask prices for the option, just like you would with stocks.
Right.
The bid is what buyers are willing to pay.
Yeah.
The ask is what sellers are offering.
Got it.
And once your order is filled,
Mm-hmm.
you own that call option.
Okay, so I've bought my Tesla call. What happens next? Do I just sit back and wait for the price to go up?
You can hold on to it.
Yeah.
Hope Tesla hits $300
Yeah.
before the expiration date. If it does, you can exercise the option,
Okay.
which means you buy the shares at the $280 strike price
Right.
and then hopefully sell them for a profit.
Okay. Sounds good. What if Tesla stalls out? What if the price drops?
Well, if it doesn't reach your strike price by the expiration date,
Mm.
the option expires worthless and you lose the premium that you paid.
Ouch. So there's a risk of losing my entire investment.
Yes, that's the downside of options.
Right.
But remember, you don't have to wait until the expiration date.
Okay.
You can sell the option before then.
Right.
If the price is moved in your favor,
Right.
you can lock in some profit.
Okay, so I can buy and hold or I can sell it before the expiration. But how do I actually know when to do what? How do I turn this theoretical knowledge into actual profit?
Well, that's where your strategy, your risk tolerance, and ongoing monitoring all come in.
Right.
Some traders set profit targets,
Right.
like a specific percentage gain they're aiming for.
Uh-huh.
Others might use technical analysis
Okay.
to identify potential price points
Right.
to enter or exit a trade.
So it's not just about picking the right option at the beginning. It's about actively managing it.
Yeah, active management is crucial.
Right.
With options,
Yeah.
you need to be aware of how the stock is moving, how time decay is affecting the option's value.
Yeah.
You need to constantly reassess your position based on new information.
Okay, so staying informed and adaptable is key.
Yeah.
You mentioned that options can be used for more than just betting on price movements. What about this idea of hedging? How can options be used to protect my existing stock portfolio?
Excellent question. And it really highlights that insurance aspect of options.
Mm.
So let's say you own shares in a company
Okay.
and the market takes a sudden dip
Uh-huh.
and you're feeling a little nervous.
I think we've all been there.
Yeah.
I'd definitely be looking for some reassurance.
In that situation, you could buy put options on those shares
Okay.
as a form of protection.
So it's almost like buying a safety net,
Exactly.
for my portfolio, in case things go south. I like that.
If the stock price drops,
Yeah.
your put options will increase in value,
Okay.
which helps to offset
Right.
some or all of your losses
Okay.
on the shares themselves.
Put options, portfolio insurance. Got it. What about the income generating side of things? We talked about covered calls earlier. Could you tell me a little bit more about that?
Of course, covered calls are a great way to generate income from stocks you already own.
Right.
So by selling call options
Mm-hmm.
on those shares, you're essentially collecting premium income from the buyer,
Right.
who's betting that the stock's going to go up.
But as we discussed, there's that trade-off. If the price goes way up, then I'm going to have to sell those shares for less than they're worth.
You might.
Yeah.
It's all about finding that sweet spot
Right.
between generating income
Mm-hmm.
and the potential for those missed gains.
Yeah, it sounds like options offer a whole toolkit for different investment approaches. So whether you're looking for speculative gains or downside protection or income generation, they're more than just buy low, sell high.
They are. They're
Yeah.
much more nuanced.
Yeah, you need to be more engaged and
Mhm.
have a bit more of a strategy. And that brings us back to the Greeks,
Yes.
which, as we said, are different measures of risk associated with options. We talked about them briefly in part 1,
Huh?
but I'm still not sure I totally get how they would inform my actual trading decisions. Can you give me some practical examples of how understanding the Greeks could make me a better options trader?
Certainly. Remember, each Greek tells us something
Yeah.
about how sensitive
Okay.
an option is to different market factors. So, for example, let's take delta.
Oh, wait.
Delta measures an option's price sensitivity
Yeah.
to changes in the underlying stock price.
Okay. So higher delta means that the option price is going to move more dramatically if the stock price moves.
Precisely. So imagine you're comparing two call options
Okay.
on the same stock.
Yeah, huh?
Option A has a delta of 0.6.
Okay.
Option B has a delta of 0.3.
Okay.
If the stock price increases by $1, option A's price would increase by 60 cents.
Right.
But option B's price would only increase by 30 cents.
So option A is the more leveraged play. It's going to move more, but it could also potentially lose more.
Exactly. Higher delta
Yeah,
means higher potential profit, but also higher potential risk.
got it. Now, let's say I think a stock is going to make a big move, but I'm not sure which direction it's going to go in.
Okay. This is where gamma comes in,
So
right?
then this is where gamma comes in. Gamma is like delta's acceleration.
Okay.
So it tells us how quickly delta's going to change
Okay.
options with a high gamma.
Experience rapid changes in their delta
Mm-hmm.
as the underlying stock price moves.
Okay.
So if you're anticipating a big swing in either direction, a high gamma option might be appealing
Okay.
because the delta will adjust quickly
Right.
to that move
Mm.
and potentially magnify your gains.
So it's almost like having a more responsive option.
Of that.
One that adjusts quickly to those big price swings.
Yeah.
But I imagine there's a downside.
There is. That high gamma also means your options delta will change quickly if the stock moves against you,
Right.
which could accelerate your losses.
Okay, so a high gamma can be a double-edged sword.
Mm-hmm.
It can be great if you're right about the direction and
Uh-huh.
how big the move is going to be.
Exactly.
But it can also hurt if you're wrong. What about theta? How does that actually play out in the real world?
Remember, theta represents that time decay.
Right, the melting ice cube.
Exactly. The higher the theta,
Yeah.
the faster the option's value erodes
Ah.
as we get closer to the expiration date.
Okay, so if I'm buying an option, I want a lower theta because I want that time decay to be slower.
Exactly. So let's say you're comparing two call options
Okay.
with the same strike price,
Uh-huh.
but different expiration dates.
Right.
Option C expires in 1 month and has a theta of 0.10.
Okay.
Option D expires in 2 months and has a theta of 0.05.
So option C is decaying twice as fast as option D.
It is. So option C is losing 10 cents of value every day
Right.
due to that time decay,
Okay.
while option D is only losing 5 cents a day.
Got it.
This means that if the underlying stock price doesn't move very much, option C is going to become worthless
Right.
much faster than option D.
I see. So understanding theta can really help me to compare
Yes.
different options and make better choices. I might be willing to pay a higher premium for an option that has a lower theta if I think it gives me more time
Exactly.
for my prediction to play out. What about Vega?
Vega measures the sensitivity to implied volatility,
Right.
that market expectation of future price swings.
Mm.
A high Vega means that the option's price will move more
Yeah.
as implied volatility changes.
Okay. So if there's a sudden uncertainty in the market, a high vega option would become more valuable.
Exactly. So let's say you're looking at two put options
Okay.
on a company that's about to release its quarterly earnings report.
Uh-huh.
Option E has a vega of 0.2.
Okay.
Option F has a vega of 0.5.
Right. So option F is more sensitive to changes in implied volatility.
Exactly. Now, as the earnings report gets closer,
Mm-hmm.
implied volatility might increase
Okay.
because traders are anticipating
Right.
maybe some surprises, good or bad.
Yeah.
And if that happens, the value of option F with its higher vega would be expected to increase more
Right.
than option E.
So if I think the market is underestimating the potential for a big price swing after the earnings report, then I might want an option with a higher vega.
You might. But as with all the Greeks, there's a trade-off.
Yeah.
A higher vega also means a greater potential for losses if implied volatility decreases, which might happen if the earnings report is a bit of a dud.
Okay, so understanding the Greeks is really about understanding the different dimensions of risk that are associated with options and finding that balance between the potential reward and all the different factors that could work against you.
That's a perfect summary.
Yeah.
By understanding how these Greeks work together,
Yeah,
you can start to tailor your option strategy
right.
to different market conditions and your own risk profile.
My brain is definitely getting a workout here. It's all starting to click for me. But I can see how mastering this takes practice and experience.
It does.
What else do we need to know before we move on to these more advanced options strategies?
Before we get into the more complex strategies,
Yeah.
there's one more key element we need to discuss, and that's the mechanics of actually executing those trades.
Okay, so let's talk about the nuts and bolts of actually trading options.
Okay, so we've covered so much in this options deep dive. We talked about calls and puts and even those complex Greeks. Now I'm really curious about those advanced strategies you mentioned.
What kind of options combinations can we create?
Well, remember those iron condors we discussed?
Yeah.
The strategy that works well for smaller accounts, where you're trying to make a profit within a specific price range.
Yeah, that's the one where you sell calls and puts to kind of create a box for your profit and loss.
Exactly.
Yeah.
You're betting that the stock stays within a certain range.
Uh-huh.
Now imagine taking that a step further and combining that with another strategy. So you could use covered calls to generate income on a stock you already own.
Right.
And at the same time, you implement an iron condor on a different stock
Okay.
where you expect limited price movement.
So you're running two different option strategies at the same time, each tailored to a different stock and your outlook.
Exactly.
That sounds like some next level options trading.
It is. It's about diversifying your approach
Right.
and capitalizing on the different opportunities in the market. There are even strategies that combine options with other financial instruments.
Okay. So like mixing options with stocks or even other types of derivatives?
Exactly. For example, let's say you're bullish on a company and you buy some shares.
Okay.
To manage your risk, you could buy put options as a hedge
Right.
against any potential downside.
So you get the upside potential of owning the shares, but you've also got that protection in case things go wrong.
Exactly. It's a way to manage your risk without completely giving up potential gains. And these are just a couple of examples.
Yeah.
The world of options offers a huge range of different combinations and strategies. It's really only limited by your creativity and understanding of how these things work.
Wow. It sounds like this can get incredibly complex.
It can.
With all these strategies and moving parts, what are some key things to keep in mind to avoid making costly mistakes? What advice would you give to someone who's just starting out with options?
That's so important. Options trading can be very rewarding, but you need to be careful
Okay.
and have a plan.
Okay, give me those golden rules.
First of all, never stop learning.
Okay.
The market's constantly changing, and options are no different. So stay updated on trends, new strategies, any changes to regulations. Continuous education is key.
So it's not a learn it once and you're done situation.
No, definitely not.
Yeah.
Options require ongoing study and practice.
Okay. Good to know. What else?
Start small.
Uh-huh.
Gradually increase your position sizes as you gain experience and confidence. Don't go all in right away
Yeah.
and risk more than you can afford to lose.
Yeah. Take it slow. Start small. Makes sense.
Exactly. Master those basics
Uh-huh.
before you take on the more complex stuff.
Right.
Okay, third thing, have a clear trading plan.
Okay.
This should include how much risk you're comfortable with,
Mm-hmm.
what kind of profit you're targeting,
Right.
and when you're going to get out of a trade if it's not working out. You need to know all that before you even start.
Don't let your emotions make decisions for you.
That's right. Emotions can lead to bad decisions.
Yeah.
A well-defined plan helps you to stay focused and avoid those impulsive trades.
So have a plan and stick to it, even when the market's going crazy.
Exactly. Fourth, utilize risk management tools.
Okay.
Most brokerage platforms these days have things like stop-loss orders,
Okay.
which will automatically sell your options if the price drops to a certain level.
Mm-hmm.
These can be lifesavers.
Okay, so it's almost like an emergency brake.
Yeah, they can really help to limit potential losses.
Got it. What's the last rule?
Don't be afraid to ask for help
Okay.
from experienced traders or financial professionals.
Mm-hmm.
There are tons of resources available,
Right.
from online communities to mentorship programs. Use them to speed up your learning and avoid common mistakes.
Great advice. Never stop learning. Start small. Have a plan, manage risk, and seek guidance. That sounds like a really solid set of guidelines for anyone getting into the world of options.
It is. And remember, options trading is a journey,
Uh-huh.
not a destination.
Right.
There will be ups and downs. The key is to learn from your experiences and constantly improve your skills.
Okay.
Approach every trade with a balanced mindset.
Well, this deep dive has been so insightful. I feel so much more prepared to explore this world of ASX options while being mindful of the risks involved. Any final words of wisdom for our listeners before we go?
Options are powerful tools, but they're not a get-rich-quick scheme.
Yeah.
They take time, effort, and a commitment to continuous learning. Approach them with respect, manage your risk wisely, and the potential rewards can be fantastic.
Well said. Huge thank you to you for all your insights and for making even the most complex options concepts easy to understand.
It's been my pleasure.
And to our listener, thank you so much for joining us on this journey into the world of ASX options. Happy trading, and remember, knowledge is your most valuable asset.